Hello everyone, good afternoon. I hope you will be fine. Please confirm through the chat option. Can you hear my voice? So guys, we are going to discuss today accounting for stocks. Okay, from unit number 1. So topic which we are covering 1.4 today we will complete it. Unit 1 and 4 is very long. Almost unit 3 is also very long. So accounting for stock we are discussing, and this is under topic number 1.4. So first of all, let me quickly tell you 3 terminologies regarding stocks. So we have a 3 definition which we need to understand. One is called stock authorized. Second is called stock issued. And third is called stock outstanding. So what does mean by stock authorized? First word. Stock authorized means, guys, like when you register your business with the government, obviously. In USA, you have a state system. So there is a Secretary of State office. There you will go. Once you are filling the form to get the registration of your business, that is called certificate of incorporation. Right? Like it's actually the incorporation. To incorporate the companies, which information you have to provide. So that is called actually articles of incorporation, where you are providing the data, right? So at that time, when you are filling the form, you have to mention how many stocks you will issue, or you would issue in the future, right? So maybe you are registered with 1 million stock or 1 billion stock, whatever. So this is called what? Stock authorized, right? It doesn't mean only at that time you can, you have to set this limit. No, you can change later on also by paying additional fee. But this is the authority to issue the stock, right? Then we have a stock issued. Stock issued means obviously the amount of stock authorized that has actually been issued by the corporation. For example, out of 1 million, let's assume you have issued, out of 1 million, for example, you have issued 0.2 million stock. Okay, this is what is called your issued stock, right? Then guys, we have another word that is called what? Stock outstanding. Okay, to understand stock outstanding, I need to add one more word. There's a one word which is called treasury stock, which is also called stock repurchased. Treasury or stock repurchased, guys. These are those stocks which a company has repurchased from the people. Right or wrong? Due to any reason. Generally, it is not allowed to buy it back, but in certain exceptions, you can buy it back. For example, I'm saying that issued were 2 million. Let's assume from there, or let me put the value like that. For example, out of 1 million, you have issued 200,000 stocks. Okay, from there, maybe you have repurchased how many stocks? 50,000 stocks. This is called your treasury stock. When you take issued minus repurchased, issued minus repurchased is called what? Your outstanding stock. Outstanding means these are the stocks which are in the hands of the public. And obviously, whenever a company will pay the dividend, company will pay the dividend on what? On outstanding stocks, right? Right or wrong? So here we go. This is what they are saying. Outstanding stock is the amount of stock issued that has been purchased and is held by shareholders. Okay, clear, guys? Like this is what is you are taking issued minus repurchase. This is what is called outstanding stocks. Now guys, we have here two types of stocks because accounting we are going to discuss today. The one type of stock is called, this is what types I'm explaining. Types of stock. Generally, we have two types of stock. One is called common stock. Common stock is also called guys ordinary shares. Stock means shares. Common means ordinary. Yeah. So anyways, you can use. And second type which we have, that is called preferred stock. Preferred stock. So what is the difference first? Guys, please remember. Number one, common stocks, they have voting rights. Voting rights means that they can participate in the decision making. Okay, like on any special matters, so you can participate. Number two is what? On common stock, the common stocks are irredeemable. Irredeemable means to say once these stocks are in issue, forever these are in issue. Okay, like from company point of view, it is irredeemable. They will not buy it back, or you cannot force the company to buy it back. I'm not saying company cannot buy it back. Company can buy it back with certain exceptions, but as an investor, you cannot force the company to buy it back from you. You got my point? So, like as a company, if I issue the stock, for example, stocks are with you. Now you want to sell, so you have to find another potential investor. Okay. Third point. Point number three. What is the point number three? The common stocks. The common stocks, their dividend is not fixed. So no fixed dividend. It depends on the choice of the directors. They want to pay more dividend or less dividend, even no dividend. It's their choice. Again, as an investor, as a shareholder, you cannot force the company to pay a certain amount of dividend to you guys. Okay. Next, dividend is paid at the end. At the end, in the sense, first company is paying dividend to the preferred shareholders. Once the preferred shareholders are paid, then dividend will be paid to the common shareholders. This is what is called, yeah, common stocks. Right, then I will add points, don't you worry. So what's the difference between common and preferred? So as I told you, common stocks, they have voting rights. So preferred stocks, they do not have voting rights. Right? As I told you, in common stocks, they are irredeemable. Right? So, but preferred stocks could be irredeemable also. Or what? Redeemable also. Redeemable means maybe at the time of issuance, when the company is issuing the stock, at that time he can tell to the investors like after specific time, maybe 5 years, 6 years, or 10 years. So we will take it back, right? And we will return your money. Like a loan. As you're taking loan today and you have to repay, so same way it will be redeemable. Okay. So then we talked about common stock like no fixed dividend, but on preferred stocks we have what? Fixed dividend. Mostly preferred stocks are written in balance sheet. It's like that. It's written in balance sheet. Like for example, 5% preferred stock and value is what, for example, $10,000. And here, let's say it's written $1. This $1 is par value, legal value of the stock. And now, guys, if you want to calculate dividend, because this is the percentage of dividend. If you want to calculate dividend of one stock, multiply 5% with $1. If you want to calculate total dividend, 5% multiply with the total par value. Please remember, whenever you are calculating dividend, you have to take percentage, multiply by par value. Don't calculate on market value or on issue price. So we calculate always on which value? Par value. Par value is also called nominal value. It is also called face value, right? It is decided by the company ordinance, companies act. You know, every country is having their own country act, company act. So it's written there, and with the passage of time, it's changing also. So actually, it's the minimum price at which stock should be issued. Minimum. I'm not saying you cannot issue above that price. You can issue, but this is the minimum price of the stock. Okay, got it? Then here, I told you preferred stock, because as per name, these are preferred because they would receive dividend in priority to the common shareholders. Right or wrong? It means first company would pay dividend to the preferred shareholders and then to the common shareholders. Clear? So this is the main difference. Now let's continue. Yeah, par value, you can say it's a minimum value. Don't say the minimum price, it's a minimum value at which stock should be issued. Okay. Then guys here. Now we have further points. Sometime with the common stock I'm attaching word. Actually, this word I'm going to explain now. For the common, this is called what? Preemptive rights. Sometimes common stocks, they ordinarily have preemptive rights. What is the preemptive rights? Let's have a look and then I will give you example. For example, it is written preemptive rights give current common shareholders, current means to existing shareholders, the right to purchase any additional stock issuance in proportion to their ownership percentages. What it is. For example, you can say it is, for the basic understanding, you can say simply it is the one clause which is written on the stock, let's assume. And it is written that, and you hold that stock. It's written that whenever company will issue the stock in future, so company first, the priority will be given to existing shareholders. Will be given to existing shareholders, right or wrong? So, for example, they will always make a policy, and because these stocks will be issued in proportionate to your existing holding. For example, policy is what? 1 for 5. 1 for 5 means one new stock will be issued if you hold existing 5 stock. If you held existing 5. For example, I hold, this is the policy which is applicable on all shareholders now. For example, I hold 10 stocks, I will get 2 new. You hold 20 stocks, you will get 4 new. If any person is holding 1,000 stocks, you will multiply with 1 over 5. You will get this much number of shares, 200 shares. Right? This is called what? Preemptive rights. It is also called right issue. Simply. Right or wrong? Right issue means you are issuing to the existing shareholders. And mostly here stocks are issued at discounted values. For example, okay. So what it is, guys? So simply it's issued at discounted prices. Clear? Like for example, market value is $10 at the date of issue, right? So maybe you will issue below the $10, maybe at 8 or 9, at 9. Okay, guys? Okay. So guys, then we have here, so this is what preemptive rights are clear. So then we have here, I'm moving back to the preferred stock. For the preferred stocks too, now for the preferred stock, 2 more words I want to attach. there is one type of preferred stock which is called cumulative. Okay. Then there is a one word for preferred stock which is called what? Non-cumulative. So cumulative preferred stock is what? It is same like here. If you want to understand the concept in easy way, put the word interest on loan. Like example as interest on loan. What it's happening? For example, let me give you example first. For example, if I have taken a loan, let's assume last year, and now it's a time to pay the interest. For example, this year, I don't have a money. Maybe I'm not able to pay due to any reason. The interest in this year. Next year, whenever I will pay the interest, so bank will not forgive me this interest, right or wrong? We have to pay next year. Whenever I will pay, I have to pay the previous also, current also. So same here, dividend scenario. Cumulative preferred stocks are those preferred stocks over which if you are not able to pay dividend in any one specific year, next time whenever you will pay, you have to pay the previous dividend also. Right? It is accumulating like interest. This is what is called cumulative preferred stock. And mostly cumulative preferred stocks are written under liability section in the balance sheet because it has more feature close to the long debt. Then we have a non-cumulative. For non-cumulative, just to understand, put the example as a common stock. Common stock in the sense here how, for example, if you are in a loss in this year, I'm explaining non-cumulative now. You are in a loss in this year and you are not able to pay the dividend. Next year, once you will pay the dividend, you will pay only the next year dividend, not the last year. This is what is called non-cumulative. So this mostly it is very close to the common stock. It's not like that you have to pay dividend, right or wrong? It's your choice also now, right? This is what is called non-cumulative. And mostly non-cumulatives are written under equity section of the balance sheet. Okay, guys. Sometime with the preferred stocks, you have a convertible preferred stocks also. Which one? Convertible. Convertible is what? For example, today I have issued the stock, preferred stock. As a company, I am giving you option today that after 5 years or any specific date, a specific year, you have a right, you have an option. Either you can convert to the common stock, like return the preferred and take the common, or you can take the cash from me. Return the preferred, take the cash. This option I'm giving you. This is what is called convertible preferred stock. Sometimes we have a participative preferred stock also. Participative. Participative means to say they will receive the dividend plus they will get some share of the profit also, but it could be conditional. Maybe if your profits will be more than a specific limit, so you have written, if it will be more than this limit, I will distribute this much profit as well, along with the dividend. That is called what? Participate. Okay? No need, this is not required for exam. So here we go. Now guys, we are moving to the main point. Equity transactions. This is our topic. Just to understand, we were discussing other things. Equity transactions. Okay. So here we go. First thing which we are going to talk about, that is called what? Issuance of stock. Issuance of stock. What it is? Obviously, when as a company we issue the stock, we need to pass the double entries. Right? We need to pass double entry, and what entry you are passing at that time. So this entry we are going to discuss. So this is the entry for issuance of stock. Either you are issuing common stock or you are issuing preferred stock. So you can pass this entry, same entry, right? So what is the entry, guys? Look at here. So this, let me just give you a simple example first. For example, company is going to issue 100 shares. 100 shares at $10 each, assuming $10 each. and the par value per share is $2. Par value per share is $2. Actually, this is your issue price, $10 is your issue price. Done. Now guys, what you have to do here? So what entry you will pass? So first of all, we will always debit the cash. How you will get the cash value? Number of shares which you issued. So you will take number of shares multiply by issue price. Number of shares, how many shares we have issued? 100. Issue price how much? $10. So this will be your cash debit. By how much? $1,000. Please note, sometimes issue price is not given separately. If issue price is not given, so we will use market value at the date of issue as issue price. If issue price separately is not given, so then market value of the stock at the date of issue we will use as a issue price. Otherwise, it could be different than market value also. Then guys, you have to credit. Credit what? Common stock or profit stock, whatever your issue. Common stock. Common stock you have to write first with the par value. So how you will take? You will take number of shares issued multiply by par value per stock. Number of shares are how much? 100. Par value is how much? $2. So this will give you how much? $200 as credit. Because par value and premium, which is called additional paid in capital, you have to reflect separately. Then credit, we will also credit what? Additional paid in capital account. It's also known as sometimes share premium. Huh? So additional paid in capital account. So how you will get? It's the difference of these two values. Issue price, this is recorded at issue price. And this is recorded at which value? Par value. The difference of this is called what? Additional paid in capital. So you can calculate, simply you can put it here 800 as balance value also. Or you can take this with number of shares. Multiply by what? Issue price minus par value. The difference you have to take. Issue price is how much? 10. Par value is how much? 2. So difference is 8. 8 times number of shares is how much? 100. So this will give you 800. Right? So this is what is called additional paid in capital. Clear? Done? That's good. Now we have here this note I have already explained. If issue price is not given, the market price at the date of issue will be taken as issue price. I hope so it is clear. Here we have a small example, just same way we will follow. We have a company issued 50,000 shares of its $1 par value common stock. Okay. The market price of the stock was how much? $17 per share on the day of issue. So here issue price is not given separately. So obviously we'll assume market price as a issue price. So first you have to debit cash. How many number of stocks you have issued? 5,000. And what is the market price or issue price? 17. So it will be how much? 850,000. Right? Then you have to credit common stock with the par value. Par value is how much? $1. Number of shares are how much? 50,000. It will be 50,000. So difference of these two, 800,000, will be recorded as additional paid in capital. This is the first entry we learned about issuance of stock. Okay. Now here guys, we have other point which is called entry for stock related issue cost. Stock related issue cost. So what is stock related issue cost? Sometimes obviously when as a company you issue the stock, you have to incur different types of issuance cost. For example, you might have an underwriting cost because sometimes you are hiring a bank, right or wrong, to issue the stock. So bank is taking commissions. Sometimes the bank will buy whole number of stocks from the company and then they will sell it to the public. right or wrong? So, but there could be a commission which you are paying, obviously. Then you have some legal cost. Legal cost, maybe you need to get permission from stock exchange. Maybe certain amounts you have to pay to them as well, right? Maybe then you have some accounting or tax related work also. For example, sometimes we issue the prospects, with the stock. In there, what you can include, like you have to inform the investors actually, like how much money you are planning to raise, where you will invest, what is the expected return, later on how much it will be distributed among the shareholders. So that kind of things we need to prepare, and it must be reviewed by auditors also. Later on, so those work you have to pay. Registration I already told you, like with the stock exchange. Okay. So what we have to do, please remember here, this issuance cost must not be recognized as an expense. No, don't book as an expense. So what then you have to do? So instead, they reduce the net proceed received and additional paid in capital. For example, guys, simply you have already credited the additional paid in capital account at the time of issuance. If you have an issue cost, you will deduct from this account. Okay, so additional paid in capital was credit. If you want to deduct something from this account, you will make it debit now. Additional paid in capital account and credit what? The cash. These are your, let's say, issuance cost is 10,000. Clear? So if you will combine these two entries, initially your additional paid in capital was credited with how much? 800,000. And 10,000 you paid what? Issuance cost. It means the balance in additional paid in capital is how much? 790,000. Done? Clear? Yes. Guys, please confirm through the chat option. Is that clear? So here we go, guys. Now we are going to discuss about what? Equity transactions. And we are going to talk about something about what? Treasury stock. Okay, treasury stock. What it is. Like, obviously, guys, just to understand, first thing, when you issue the stock, right or wrong, at that time you have to record the entry at the time of issuance. And treasury means say at the time of repurchase, when you are buying back the stock, when you are buying back the stock, again at that time you need to record this financial transaction, this event, right or wrong. So that is why we are going to talk about now accounting for treasury stock. So now there are two scenarios. What will be debit, what will be credit, don't you worry. So there are two scenarios are there. Sometimes your acquisition price could be greater than what? Original issue price. Maybe I issued the stock 5 years ago at $10. But today I'm buying back at what? $15. Obviously I'm paying more. This scenario is called acquisition price is greater than original issue price. And how you will do, we will see. Then we have second scenario where our acquisition price is less than what? Original issue price. For example, originally stocks were issued at 10. Now you are buying back at what? 8 or 5, whatever. So, but acquisition price is less. Right or wrong? So, how you will deal with it? Obviously, this, it seems like a gain to you. It seems, right? And here, when your acquisition price was more than original issue price, it seems like a loss to the company. Right or wrong? So, but how the accounting will be done for equity method, need concentration. So, guys, For treasury, for treasury stock I'm talking about, not equity method, treasury stock. So we can use two models, cost methods and what? Par value method. So you have to choose one of them, right or wrong, and whatever method you will choose, you have to apply consistently. So we have two methods. One method is called what? Cost method. And second is called what? Par value method. Right? How it is going to work? Let's have a look with the help of example. So we have a company here, P reacquired. Reacquired means repurchased. 5,000 shares of its $1 par value. Common stock for how much? $20 per share. The stock had originally been issued at what? $17 per share. This is the issue price. P had no prior treasury stock transactions. So guys, you want to do the accounting. So before moving to the accounting at the point of repurchase, first think what was the entry when you issued the stock, original entry. Okay, original entry, what was the entry? So we are placing here. So you will remember the facts and take it. So when we issued at the time of issue, what entry you have passed, right? So you have debited the cash. How you will get the cash number of stocks which you issued? I'm assuming it's the same. How many stocks? 5,000. And what was the issue price? 70. So 5,000 shares into 17 is the issue price. So this will be double cash. How much? 85,000. Right? 85. Huh? Okay. Yeah. So credit will be what? Common stock. Just check the arithmetical accuracy only. Yeah? Credit will be common stock with the par value. You issued 5,000 shares into $1 is the par value. So this will be credited by 5,000. Then you have to credit what? Additional paid in capital. The difference. Difference will be how much? 80,000. Now you can take 5,000 shares and difference of issue price and par value is how much? 16. Okay. It is 80,000. Done. This is the entry with you. Don't forget. Clear? Now I'm going to tell you cost method. Cost method is very simple. As per cost method, now you required the stock. You required the stock at which value at? You required how many number of shares? At which price? At 20. Right? It means you paid. Your cost is how much? $100,000. If you are using cost method, you will pass this entry. Debit treasury stock and credit what? Cash by original cost. How much? 100,000. And this treasury stock, obviously, it is a negative value in the equity section. You know, in equity section, when you write share capital, additional paid in capital, right or wrong, retained earnings. So from there, you will subtract what? Treasury stock value as a negative. Clear? This is cost method. I don't think so there is any rocket science. Now here we have which method? Par value method. Par value method is what? In fact, you have repurchased the stock. So again, you will debit here treasury stock. You will debit first thing. With par value. Okay? With par. Here you debit treasury stock with the reacquisition price. Here you are debiting treasury stock with the par value. Right? So by how much? 5,000. Or in other words, I can tell you this way. Because look at here you have these two accounts. Which two accounts? Common stock and additional paid in capital. You know, you repurchase the stocks. You should remove from these accounts and put into the treasury stock accounts, right? If you want to remove, tell me what entry I should pass now. I should make debit these two things, right? I should debit what? Common stock with the par value how much? 5,000. And I should debit here additional paid in capital account. And wait a minute, what amount I have to write? I don't know. Just wait. Credit. Credit, you will pay the cash. Cash, how much you paid? 5,000 shares you bought for 20 each. You paid how much? 100,000. Now, guys, obviously, because you repurchased all the stocks, the full value of additional paid in capital, because cash paid is more than 85,000. It means these two accounts I can remove now. Right? So 80,000 full value of additional paid in capital I will debit. Will my entries tally? No. There is a difference on debit side of how much? 15,000. Actually, this is your loss. Because your reacquisition price is more than originally issue price. So this loss you will debit to which account? Retained earnings account. And look, you repurchased at which price? 20. Original issue price was how much? 70. So there is a loss of how much? 3. So how many number of shares? 5. So total is how much? 15,000. This is the difference. Okay? Got it? Clear, right? Now, this is how, which method will work? Par value method. The cost method is simple. Debit, treasury stock, credit, cash. Got it? If I will ask you simple question here under par value method, how much balance is left in additional paid in capital account? 0. Because it was debit initially with 80, it's credited with the 80. So it's 0. Common stock as per this transaction 0 also. Retained earning will reduce by 15,000 and cash will reduce by 100,000. Done. Now I'm going to tell you second scenario. Scenario number 2. What's the scenario? If acquisition price, reacquisition, I would say, repurchase price is less than what? Original issue price. So let's keep the same data and how it will work now and changing this information. For example, originally you issued stocks, 5,000 stocks, at which price at 17. This is the original transaction, right? And for that you have already passed the entries, right or wrong? At the time of issuance, you have already passed this entry. Clear? You already passed this entry. Now, next information I'm changing. I'm saying that you have repurchased the stocks now. You have repurchased the stock at which price at? $10. Original issue price was how much? 17. And reissue price is 10. It means the acquisition price is less than original issue price. So it is kind of gain for you. Right? So here we go now. So how you will do the accounting now? Again, cost method. What is cost method, guys? Cost method is what? You will first debit the treasury stock with original cost, whatever you have paid actually to buy it. Credit what? Cash. You paid how many stocks? You paid $10 for how many stocks? 5,000 stocks. So it is 50,000. Clear? Done? Now look at the par value method. I'm asking you now. Do you remember the original entry? Original entry was what? Yeah, let me take you here. This was the original entry. Let me remove this. Now on your screen, this was the original entry, right? Now guys, you want to debit credit again at the time of repurchase. So you will do. First of all, first thing cash. cash you paid, it will be credit. How much stocks you bought? 5,000. At which price now? 10,50,000. Correct. And remove this account. You will debit now what? Common stock with how much? 5,000. It means how much balance is there now? 45,000. But in additional paid in capital, total balance is 80. Out of that, I want to remove only 45. So I will debit the additional paid in capital by 45,000. Now tell me how much balance. That's it. How much is the balance finally in the additional paid in capital account? 35. Because 80 was total, 45 is removed. 35 is there. And actually, this is kind of gain I'm saying, because you issued at which price? You repurchased at which price? So there is a gain of $7 per stock. And how many stocks? 35,000. So this balance is left still in additional paid in capital. So what we learned here, if you have a loss will be debited to the retained earning account. But if you have a gain, don't credit the retained earning. It will stay in the additional paid in capital account in the balance sheet. Got it? Clear? This is what is called accounting for treasury stock. Done? So please remember also this point as well. Treasury stock has no voting rights and receives no cash because it's with the company itself. So you cannot pay dividend to yourself or distribution in liquidation. It's with the company, right? So here it's written also, guys, if the acquisition price is less than what? Par value of the stock required. Do you acquire below the par? The difference is an increase in paid in capital from treasury stock transactions. Right or wrong? Gain or losses we don't record separately, obviously, in profit and loss account. Right or wrong? Because we are dealing with our own transaction. This is the key point here. Okay? Is that clear? Now we are going to talk about dividend. Guys, please confirm through the chat option. Is that clear? If you have a question, you can ask me. Now we are going to talk about what equity transaction, cash dividend. Cash dividend. So guys, please remember here before moving to the dividend side, you guys try to understand. So there are three important dates which are really important from dividend point of view. One is called date of declaration, DOD. Date of declaration. Like this is the date when the dividend is announced. Okay. I'm assuming, for example, it is the 30th September 2022. Assume. Then I'm saying that there's another date which is called date of payment. Actually, it is the date when dividend is actually paid. I'm assuming here, for example, it is 31st December 2022. Right? Now, in between, there is a date which is called date of record. What? Date of record. I'm assuming, for example, it is 15th December 2022. Actually, what is date of record? Keep separate, simple. Date of record means at this date, at this specific date. Mostly the date of record will fall, 2 or 3 weeks before the date of payments. At this date, company will check its system. Obviously, in the system, they know like who holds how many stocks. They will check its system, and they will see who is the owner at this date of for the number of stocks. Maybe there are thousands of number of shareholders, so they will take their names actually. So that is called date of record, like who is entitled to receive the dividend. Now try to listen to me what I'm saying. For example, on 15 December, I was the owner of the shares, and they took the data. It means they will pay me the dividend. Maybe even on very next day on 16 December, if I would sell the stock, so dividend I will receive still, because the date when they check the system, I was the owner. So that is why usually the people they don't do the transaction 2 or 3 days before the date of record. The reason, because sometimes companies are taking times to update their system. It seems like if you are making credit card payments, maybe today payments from the credit card, maybe it will be shown in statement after sometime 1 day, sometime 2 days. So there is a risk for the seller and buyer, right or wrong, if they will do the transaction very close to the date of record, maybe 1 day before, because this transaction maybe will take 2 working days to update. You got my point? So that is why mostly people stop the transactions. So, but for you, this story is not important. For you, the story is date of record, the date at which company will check its system to see who is entitled to receive the dividend. That is called what? Date of record. Got it, guys? Please remember, entries, if you will pass the entries at the date of announcement and at the date of payment. Announcement and payment. No double entry is required to the date of record. No entry. Clear? So here we go. So now, guys, types of dividend I'm going to tell you. Types of dividend. Please try to understand. There are different types of dividends. For example, first type we have a cash dividend. So written everything in the sheet. First type cash dividend. Okay. So please remember, for cash dividend, what accounting entries are required? For example, first entry you will pass at the date of declaration announcement. What entry you will pass? You will debit retained earnings account. The reason, because dividend is always paid from the profits, and profits are the part of retained earnings. So you have to reduce it. And you will create the liability. Credit the dividend payment, right? With the amount of dividend. Clear? Then you have to pass the entry what at the date of date of payment. Obviously, the liability which you have already created, now you will debit it, you will remove it. Debit the dividend payable, and credit what? The cash or the bank. It's a source which you are using to pay the money. Okay? Got it? This is what is called cash dividend. So we have a small just example to understand here. For example, guys, on September 12th, the company's board of directors declared a $3 per share dividend to be paid on October 15 to all holders of the common stock. Declaration date is September 12. Payment date is October 15. Right or wrong? And dividend is how much? $3 per share. On the date of declaration, for 40,000 shares of common stocks were on, please don't calculate dividend on issued or on authorized. No, you have to take outstanding. What are the outstanding? Issued minus repurchased stocks is called what? Outstanding. On outstanding, you have to calculate the dividend. Right? So, and we told you directly outstanding 40,000 shares. So if you will calculate the dividends of 40 times $3 per share, it's 120. What entry you will pass on the declaration date, September 12. Debit retained earning credit, dividend payable. Clear? On October 15, payment date. Debit what? Dividend payable and credit with cash are important. Clear? This is how to deal with the base dividend? Cash dividend. Then guys, we have a property dividend. Huh? Property dividend is what? Sometime, just give an example. Maybe company, they might pay the dividend in shape of any what? Tangible property. It could be land, building. Maybe they will distribute that asset. That is called what? Property dividend. And how this property dividend is going to work? Let's have a look with help of example. Let's create small example. For example, at 30th September, company announced the dividend, right? And what they're going to distribute the building, for example, as dividend, building as dividend, right? And the carrying value of the building, carrying value means the value which is showing in the balance sheet, carrying value of the building, or it could be any asset, guys, tangible asset. Building is, for example, is equal to, let's assume 30,000. I'm assuming 30,000. Carrying value, cost less accumulated application. Right or wrong? That is carrying value. It's also called book value. Now, guys, the fair value, market value of building at that date is, for example, 45,000. Scenario number 1. Scenario number 2, it could be what? Less than 30,000. Okay, but I will explain them to you. Then, guys, this is the fair value. Right, and dividend is, let's assume, going to distribute it as dividend on 31st December, assume. So what I will do, first of all, add date of declaration. Add date of declaration. What do you have to do? You have to ask the question from yourself. Is fair value equal to the carrying value? You have to check. Answer could be yes or no. If it is yes, no adjusting entry is required, because carrying value is always equal to or already equal to the fair value. But if your fair value is greater than, scenario number 1 I'm creating here. If fair value is greater than what? Carrying value. This is called gain on remeasurement. Right? A secondary could be what? Your fair value could be less than carrying value. It is called loss on remeasurement. So what I'm trying to say, actually, initially you have to bring your assets carrying value to the fair value. This is called remeasurement. And obviously you have to remeasure the assets to the fair value if carrying value is different. Right or wrong? In my example, fair value is how much? 45,000. Carrying value is how much? 30,000. If this is the scenario, what I will do, I will debit the asset means in the building account. And I will credit the gain on remeasurement. This gain I can take it to the income statement. Okay. And how much gain I have to book here? 15,000, right? Right or wrong? Because already asset is showing in my balance sheet at 30,000. If I will add more 15,000 into that, it will be equal to fair value. right? If there is a loss, you have to reverse the entry, guys, in case of loss. So what do you have to reverse the entry? Debit loss on remeasurement and credit what? Assets. This entry you will pass. So this is actually the step number 1. So what is the step number 1 at the date of declaration? Remeasure the assets to the fair value. Obviously, remeasurement is required if carrying value is different. If carrying value is same like fair value, then remeasurement is not required. Got it? This is the first entry you will pass at the date of declaration. Clear? Second entry. Again, you are sitting at the date of declaration. You will pass another entry also. Understood? Do you want to write? Sir? Yeah. You want to write, huh? It's done already. Okay. Now we have here second entry. So you have to debit retained earnings account. Which account? Retained earnings account with the fair value, because your assets carrying value is equal to fair value now. Okay, so you will debit it. If I'm giving you something, let's assume it's reduction in my net assets. Right? Retained earnings is net asset line. Part of net assets. So retained earnings debit with how much value now? 45,000. And credit is what? The property dividend payable. Property dividend payable as liability. 45,000. So these two entries you will pass at the date of declaration. Here. Done, right? Now you will move to the date of distribution, because you are going to distribute the assets as a dividend. So now third entry you will pass at the date of distribution. Payment you can say. Right? So what entry you will pass? You will debit this liability which you have created previously. Debit property dividend payable. And what should be credit? Cash? No. Credit asset which you are giving. Asset is building. Credit asset account. Right? So these are the entries. Clear? Done, guys? Here we go. We have a small example. For example, we have on August 1. A company's board of directors declared a property dividend, which is what? The land, to be distributed on December 1. This is distribution date to the holders of common stock. On August 1, the carrying amount of the land carrying value to be distributed is 50,000. This is on August 1. And its fair value is how much? 80,000. So what entry you will pass? Obviously, your carrying value is different. So on August 1, your carrying value is how much, guys? 50. And market value is how much? Where it's given? Here. Right? So now what you will do is, it means you have to bring carrying value to the fair value. You have to increase carrying value by 30,000. So you will debit land, credit what? Gain on remeasurement. 30,000. Now your land is standing at 80. Because 50 was already there, 30 you added now. It is 80 now. So you will create another entry on the same date. You will debit retained earning, credit what? Property dividend payment. Right? And then on December 1, the payment date. So debit property dividend payable, credit what? Asset account, which is land account. Then guys, I hope it is clear. Okay. Now guys, we have here stock dividend. Stock dividend. Okay. What is stock dividend? Please focus here. For example, just let's create the example first, because with example I can explain only. Because here we are talking about more about cap rule. Example. For example, a company have old issued stock. How much? This is old stocks which they have issued. 10,000. Now company is planning to issue new stock as dividend of what? 1,000. Okay. So is it a stock dividend or not? First gap says you have to calculate the percentage of new issued stock. Like convert into the percentage. How much percentage you are issuing? And how you will take new stocks, which is how many you are issuing? 1,000 divided by what? Old stock, which are what? 10,000, and multiply by 100, get the percentage. Check this percentage. If the new percentage is 25% or less, 25% or less, it is treated as stock dividend and its accounting is different. If the percentage which you are issuing, new percentage, is more than 25%, it is treated as what? Stock split accounting you will do. Actually, for separate accounting, we don't have it, just a memorandum entry to adjust the records on. So that is why whenever you are going through the questions from your exam or from software, make careful first, making sure first that is it percentage is 25% less or more, because according to that you have to answer the question, right? If it is less, so you have to deal according to stock dividend rules. If it is more, you have to deal according to stock split rules. Okay, so here scenario number 1 we are discussing here. I am assuming if it is a stock dividend. Stock dividend means that the percentage is equal or less than 25%. Obviously, then it's treated as stock dividend. Right? So how you will do the accounting, guys? Let me just give you idea about it. So here we go with the help of example. Let's understand. On May 1, a company's board of directors declared and paid a 10% of stock dividend. By the way, declaration date and payment date is the same, right? On the 45,000 shares of what? Common stock outstanding. Okay, what's the par value stock? $1. The stock was trading at how much? $15 per share at the declaration date. So this is the market value. Now guys, what entry you will pass? Because the payment date, I'm assuming payment date and declaration date is the same. So what you will do, guys? So first of all, you will debit the retained earning account. How many stocks you are issuing? Because you issued how many stocks? 10%. So old stocks are how much? 45. If I will take 10% of that, it means new stocks you are going to issue 4,500. So 4,500 multiply by, because even you are giving these stocks free, but you have to deduct something. Obviously, if I'm giving you something with a price of $15, it means for me it's a cost of $15, right or not? So we will take the market price at the date of declaration. If issuance date is different than declaration, this price you have to use a declaration date. Debit retained earning with number of shares times market value. This will be the retained earning debit. Credit will be what? Common stock. 45,000 shares. I would say 4,500 shares directly you can take. Multiply with the $1 par value. This is 4,500. And the difference of these two, obviously, where you will take it to the additional paid in capital. Clear? This is how you will deal with the what? Stock dividend. Okay. Now, what is the stock split? Stock split. For stock split, you don't need to pass double entries. By the way, memorandum entry you can pass, like just to adjust your records. So what is the stock split? Stock split means again it's like a stock dividend. You are giving free stocks to the existing shareholders. Right or wrong? So in stock split, 4 things will happen. Please remember. Okay. So how it is going to work? Let's have a look. And these 4 points you need to memorize about the stock split. So for example, before stock split, no entry is made. As I told you, double entry is not required by accounting standards. Memorandum entry you can pass just to adjust the brackets. But here we go, guys. So for example, we have here data. We have a number of stocks here, par value per stock here. What total par value? For example, it's written like that. Before stock split, we have number of stocks how much? 1,000 or 10,000. Par value per stock is assume $1. It's memorandum we are doing. Total par value is how much? 10,000. Okay. Now, guys, in stock split, what will happen? Because you are issuing free stocks, obviously number of shares will increase. Right or wrong? Maybe if you made stock split 1 for 1, like if you hold one old stock, you will get one new stock. So if old stocks are, for example, how much? 10,000. So 10,000 new stocks will be issued. So total stocks will increase automatically to 20,000. Okay. This is the first question he will ask you. What is the effect of stock split over number of shares? You will see number of shares will increase. Then second question. Please remember total par value should remain what? Unchanged. Par value don't touch. Unchanged. It should be as it is before. Okay, now it means here we were multiplying 10,000 with 1. So you are getting how much? 10,000. Here we have a 20,000 shares. With which value I will multiply? So I will get 10,000. So with 0.5. So obviously then par value will decrease. So 3 things. Number of shares will increase. Par value will decrease. Total par value will remain unchanged. And voting rights will also remain unchanged. Your voting rights. Maybe previously if you were holding 10%, still you will hold 10%. Because if your shares has increased, total number of shares of the company also has increased with the same proportion. So your voting rights will remain unchanged. This is what is called stock split. Clear, guys? So guys, this is what is for today. Now we have a topic in next class. We will talk about what statement of cash flows. Okay, guys. So today your topic is 1.4 is completed. I know I'm taking much time. So, but we are going slowly. So please, you have to do the question now from software. Topic number 1.4 completed today itself. Huh? Thank you so much, guys. Thank you so much. This sheet I will share in the WhatsApp. Thank you so much.